Good evening, everyone. Thanks for joining us, and thanks for taking out time for this spaces. It's a long-awaited space, and finally, we are very excited to host you.
Yeah, thank you so much. So, guys, thanks for joining in. Eventful day today, and I believe a lot of you would be worried as to what needs to be done, especially those who joined the markets after the crash of 2020. So, I would only say that traders definitely would have incurred losses if they didn't keep their stop losses. But for investors, it's nothing to worry at the moment. We haven't seen anything. If let's say if your portfolio is down 10 to 15%, it's very normal. I mean, anything between 20 to 30% drawdowns is very normal. I'm talking about the investment portfolio. Obviously, traders would keep their stop losses of 2 to 5% based on their risk appetite. But it's important that investors do not panic. Nothing has changed on the fundamental front. In fact, the economy is just opening up. So there's a lot of traction which is ahead of us. Yes, there has been some euphoric buying in the last 1 year after, especially the COVID blows that we made in March 20. But having said that, the economy is just opening up. We haven't been on full steam in the last 1 or 2 years, if you can, take a basis of March 2020. So airlines,
Right.
so the economy hasn't been on full steam. The hospitality industry has suffered, the airline industry has suffered, manufacturing industry has suffered, railways has suffered. So if you think of it, we are just getting started into a very good economic growth. So whatever you are seeing in this week or probably some bit of next week, would be a passing phase. Yes, FIIs have been selling. That happened because India was the best performing emerging market since the COVID lows. So obviously they would book profits, and that's why you have been seeing, the emerging market, the flows outside emerging markets, especially India. So if you would have seen my tweets, I had a few days back, I tweeted about the MSCI EM index. So the entire emerging market space has been, seeing outflows right from February of 2021. So it's been almost an year of outflows from emerging markets, thanks to the surge in the dollar index. So the dollar index was peaked out at around 103, then it dropped to 89, and then it started rising again, now close to 97, 98. So when the dollar index starts rising, you will see outflow from the emerging markets, because if the dollar strengthens, it doesn't make sense to stay invested in emerging markets that have weaker currencies. So as the dollar surges, emerging market outflows, start, and obviously, you'll not see too much of, outperformance in emerging markets. Now, India that way has done really well because our economy has been doing well thanks to the demographics. Our consumption is good. The population, the middle class has been consuming well. So India was by far the best emerging market, or rather, I should say one of the best emerging markets. And we had to go through some profit booking because sooner or later profit booking does kick in. So if speaking technically, if you see Nifty on the weekly RSI had crossed the 70 mark long time back. So it was just
Correct.
just moving around there, and and historically, if you see, Nifty RSI at 80 has always been followed by a correction. So this is the same correction that we are seeing, because Nifty weekly RSI had hit 80. And even when you can see all the past data, I mean, previous years, even decades, if you see, whenever Nifty has hit the 80 mark on the weekly RSI, it has been followed by a profit booking and correction in the prices. But see, these corrections, should be used as a buying opportunity. Again, I'm not suggesting that you should go ahead and buy immediately. You can stagger your purchases, but none of the fundamentals have deteriorated, so that just to you go ahead and dump everything from your portfolio. Yes, so there have been some stocks that have taken a beating, but nothing has changed as far as the fundamentals concerned. Even the long-term chart setup for all these stocks, if you go through monthly charts of these stocks, they're still very much in the uptrend. So the cause of concern would be if you are making major lows, let's say, whatever March 2020 lows were made, we have made significant gains from that. Many stocks multiplied 4x to even 10x from March 20 lows. Now, I do remember Tata
Right. So
Motors was, at 65 in March 20, and people were too scared that you are seeing complete lockdowns. Who will buy a truck? Who will buy a bus and all? And then there were hordes of people running after Tata Motors at 500. So this is how the psychological or the emotional part of the market works. We think in present times that if there is a lockdown, who will buy this, who will go, and who will travel. But the markets will always think ahead. They'll think 6 months to a year ahead of you. They do not go ahead and follow the news. The news is the last thing to come out that you and me get. By that time, the smart money or the FIR money or the who are the informed investors, they would have already bought what they wanted to buy, because they know that the lockdowns or even the pandemic, I mean, it was a worldwide event. Nifty crashed big, from 12,400 to 7,500, almost, 5,000 points. And in percentage, if you see, this is much bigger than what we have seen so far. And if the technical indicators are to be seen, I mean, we are already oversold on the daily charts for Nifty and many stocks. So, it's nothing to fear at the moment. It's a standard technical correction that you are seeing. None of the fundamentals have changed. It's all about keeping your nerve and, staying course. Because if you book losses right now, then you'll be, staying with those losses forever. So this phase will pass. I mean, according to what I see on the chart, this phase will stay short-lived. Yes, there would be, some volatility going ahead, because there are too many moving parts. The dollar is not, giving up that easily. There's too many geopolitical things happening. China is also now coming into picture. So it's not an easy, it's a black and white. Obviously, it will work in shades of gray, and that is how we have to operate with. But long-term trend is very much up. And these short corrections or 10-20% corrections on the index will keep coming. This is not the first one. This won't be the last one. You will see many such episodes. Maybe another 2 years down the line, you might get another 20-25% off the index. But for investors, these are good opportunities. Stagger your purchases. Don't go and put everything in one go. You can buy some, wait for the next week, watch the price again, and if it you feel that the prices seems to be stabilizing, then you can maybe go ahead and make the remaining purchases. But I don't think that there is any cause of concern at the moment, because even fundamentally nothing has changed. In fact, fundamentals are only going to improve from here. So I mean, there is no need to panic. Yes, the emotions are extreme at the moment. So like we have emotions while going up, we have emotions while going down. So I tweeted a while ago, now people are again out with Nifty 5,000, 6,000. You will see, when the index is going up, people tweet about 20,000 and 25,000. When you start going down, you get extreme targets on the downside. It's all about human psychology, human emotions that are playing in the market. You just have to stay put and, stay invested and ride through it. So just I wanted to.
So, like you talked about human psychology, like how does one develop that temperament in the market? Like over the years, obviously, as a beginner, the psychology takes a hit when you take a trade, and suppose there's a new trader who just started trading 2-3 months back. So the gap down that we saw today was humongous, and option buying, option selling तो छोड़ दो, option buying, trading, swing positions, सारे positions सबके loss में जा रहे हैं. तो how can we deal with such a situation? Like how can I'm sure there might be someone who in the listeners section who is going through something similar. So how can they deal with it? Like how do they develop that temperament and आगे इतने ज़्यादा जो emotional jitters होते हैं इसको कैसे control करें?
So to answer that question, see, first of all, you need to know whether you are a trader or an investor. Now, a lot of people that I talk to, they are not clear whether they are an investor and trader. So they use the market as a casino. That let's put some money and see if I can make some quick money. So if you are trading, you need to have strict stop losses. So if you are not operating with a stop loss, then you are at the wrong place. Because financial markets, nobody can predict right to the T. It will always have uncertainty. Yes, technical analysis will give you, a sense of direction or maybe possible supports where the market can take support or the resistance where supply is, but it's not 100% foolproof science. It only is a game of probabilities. You are not operating with a stop loss. Being a trader, that's the biggest error that you are making. So if you are getting into a trade, especially in volatile times, you have to be prepared that your stop loss would be hit. But that way you are saving your capital. If you are operating with a stop loss, then you are risking your entire trading account getting wiped out. But as an investor, you have to watch on larger time frame. Let's say if you have some knowledge of charts, or you are investing for a long term, look at higher time frames, whether your chart is telling you something, whether the higher time frames are getting disrupted or not. Let's say if a monthly chart is getting disrupted, then definitely it will be a cause of concern and you will exit even if you are an investor. I'll not keep sitting on my portfolio stock and see it deteriorate week on week or month on month. If a weekly, if a weekly or a monthly chart gets distorted, definitely you will have to exit even if it's an investment. For traders, you have to encounter a lot of noise because you are working at a very short time frame. There's too much noise on a day-to-day basis. You are trading for the day or for next 2-3 days. Trading without stop loss is a sin. So if you are not keeping a stop loss, you are risking your trading account going to zero. So it's always important that you have a stop loss if you are a trader and do not risk too much. I mean, especially if you are using the money that you might need in the immediate future, then it's a big risk. Always use the capital that you may not need in the immediate future, let's say 6 months to 1 year. If you are using your immediate salary that gets credited at the end of the month, that means you are risking too much. Always use the capital that you would not need in the immediate future because God forbid if there's an emergency, you would not have the required capital to cater to that. So everyone wants to make quick money in the market. That is what we are here for. But the problem is markets are too uncertain. All the TAs in the world can only predict possibilities, but there is never a certainty or to a 100% surety. So always probabilities and possibilities will come into picture. But if you are using your capital that you are going to need in the immediate future, that's a big no-no.
You're right, sir. Sir, also you've been, covering stocks like the commodity sector, the stocks in the commodity sector like methanol, graphite, India. So what is your view on the metal index and where do you see it going in the near times?
So see, a lot of people have posted questions to me that, metals are going through, they are all at all-time high. Aluminum is all-time high. Copper is doing well, it's almost at, if not 80th right now, but very close to all-time highs. Many other metals are at all-time high, but why are the company stock prices not reflecting? So I'll give you a brief background. See, the last time the commodity prices peaked out was in 2008. Since that time, for last 13 years, commodities have been struggling. There was no fresh capex. The books were not good. I mean, too much debt on all these companies, commodity and metal related companies. They had amassed too much debt. And now the commodity prices have started inching up from, as late as 2020 or early 21. But these companies will now take little bit of time to get their books in order. Now, if you see, sales management commentary, they plan to go debt free in next 3 to 4 quarters, if I'm, reading it correctly. So a company of the size, a biggest steel company in India going debt free, you are looking at a straightaway re-rating of the stock. So they know that, and that is where the fresh capex will start coming in. Right now, there was no capex in the last 13 years. No fresh, mines were added to, let's say, in copper or a Hindalco. Everything stagnated because, the commodity prices had hit a low. So companies did not have the fund flows to, actually go for capex. Now that cycle is turning, the books will start improving. They will have cash on the books. They will go for fresh capex, and obviously, the manufactured raw material or the mined product that these companies actually take out, they will be getting good prices. So as the books start looking better, your stock prices will eventually reflect that. So it's a 13-year story. So it's like, a kid is born today, has a bad habit, and continues that bad habit for 13 years. Now he, gets into a teenage. You cannot expect that kid to drop that habit, overnight. It will take some time for that kid to, drop those habits, because it's been 13 years that guy has been doing that. So once the habit drops, the kid will grow into teenage and obviously, grow up as the age progresses. Same thing is happening with these companies. They have, their books were in terrible shape because their commodity prices were not doing well. Now their books have started improving. Their debt is reducing. They are all looking at, eliminating their entire debt, and that would eventually reflect on the stock prices. So it will take time, but eventually it will reflect.
So, sir, like we see such event, the current one going on, and the Russia-Ukraine issue. So, what impact on credit cycle you see with such issues? I mean, such ongoing issues.
See, that is what I tweeted a while back. I'm not sure if you guys got a chance to see it. See, all the central banks have been turning a bit hawkish on because inflation has been catching up, and thanks to the commodities and especially energy and crude, everything has been shooting up. So if you see, natural gas is too expensive in Europe. So Europe is actually facing energy crisis. So it was a no-brainer that all the central banks had to tighten to keep inflation into control. Now the biggest challenge all the central banks are facing is, if they tighten, they are looking at a financial market crash or a deep correction. And if they don't tighten, they are letting loose of inflation. So commodities, if you see all the commodities spike today, not because they think that central banks will start losing, because Russia is a big commodity producer. But eventually this trend is going to continue because none of the central banks can afford financial market crash. So especially US Fed is in a position that they cannot take a clear stance now. If they tighten, they see stocks tumbling 5%, 10% like we have been seeing. And if they don't, then inflation will run amok. So it's a consensus. They'll have to bring in that which one is better off for the country. US still has pretty low inflation, so they can still manage. The target was 2% for all these years. They were not able to meet it, but now somehow they have seen high inflation. Earlier, Fed was maintaining that it will be transitory because of the supply issues, supply constraints, and supply chain issues because of COVID. But eventually, they realized that it's not transitory; it's here to stay, and commodities are the culprit. But the commodity cycle is just turning. Every country has announced massive infra plans, infra budgets. US has 1.3 trillion. Indian budget in India would have seen massive spending on infra. Infra being the biggest job creator, and it's the best thing to revive an ailing economy. China did that for years. Now they are trying to shift to a services-based industry. but US, even many countries in Europe, and even India, everyone is now spending money on the infra sector. So that would need a lot of metals, not a lot of cement, and to add to that, demand will be coming from all these. So inflation is here to stay, and all the central banks now are in the biggest challenge is what to do next. Control inflation or let the financial markets crash. Now, India has, very less penetration in terms of if equity investment is concerned, but the West is, every other household is invested in equity market. So if the equities crash, it's a big dent on the savings and the overall economy of the country. So the West can't afford a financial market crash. So it's a big conscious call the central bankers would have to make. ECB, let's see what they would do. Fed, I think again, they would have to turn a bit dovish because they were talks of 6 rate hikes and then 4 rate hikes in 22. But let's see where the ball stops. My assumption is that based on the technical charts, all the commodities are setting up for a big rally. So I'm assuming that the central banks may follow a loose monetary policy, rather continue to follow a loose monetary policy, and let the inflation spike rather than let the financial markets take a tumble.
Yeah, thanks.
Sir, I personally love your elite wave analysis. So can you please walk us through your analysis on the broader indices in the current markets, like on Nifty, Bank Nifty? What are the levels that you're watching at, and how does the chart structure look to you?
Sure. So Bank Nifty, I have not been following carefully, and to be honest, most of us were hoping that 16,800 would hold on. On Nifty, but the next is the 16,410 is what we made as a bottom in December, if I am not wrong. So as long as 16,410 was held, we could have done a flat correction, and this was kind of a fourth wave in the final fifth wave that we have been doing. So initial assumption, there were too many discussions between analysts whether it's a larger wave 2 or it's still the fourth of the larger wave 1 which is in play. But looks like if you do a minute wave count, it still looks like a wave 4 in the final fifth wave of this from the wave that started from March 2020 lows. So it was earlier following a triangular wave, forming a triangle because we made it bottom at 16,800, 410. Then we made another bottom at 16,450, which was higher than the previous one. So it was following a triangle, but unfortunately that broke down today. So I was hoping that at least 410 should be respected, so that we end up making a flat ABC flat on Nifty. But even 410 has given up. So that that opens up 15,800, which is still within the boundaries of wave 4 correction. 15,800 to 15,900 has opened up today, because if 1410 would have respected, we could have considered that we made a flat correction, because 410 was the low of wave A. Last time we hit on lower Nifty. Then we went higher up till 17,000 odd in wave B, and then wave C would have again got terminated at 410, making a flat or a double bottom, like we want to call in general terms. But in Elliott wave terms, it's called a flat correction. But even 16,410 is also given up. 16,410, sorry. So we are not looking at a flat as well. So it might be a double zigzag ABC, and then the C might again go a bit deeper. So that's what we are looking at. So 15,800, 900 zone has opened up for now. So looking at the close today, we might again have some weakness tomorrow morning, because we've closed at the day's low. There was hardly any recovery seen, so it was all in all a deep red candle for the day. So since we have closed with excessive selling, the selling might continue, rather I believe should continue tomorrow as well. And if this 15,800, 900 zone is reached, then that is where I feel that we might get a bounce from there. But looking at the daily charts, we'll become oversold tomorrow, but that would not be the end of, because I don't see a divergence yet. So it's possible that we get oversold tomorrow, see a small spike up, and then follow another low or a lower low with a divergent RSI. So if tomorrow we see a jump, please don't get into buying. This is for traders. Investors obviously need not worry on day-to-day price movement. But if we do see a bounce tomorrow, or let's say on Monday, that would just be a short-term bounce according to me, and will most likely get sold into. And we then touch again the lows or a lower low, and we'll have to then see how the RSI behaves. If we get a divergent RSI on daily chart, then we can hope for a sustainable bottom there.
And sir, if we see today's data of FII selling and DII bought, 7,667 crores and FII sold 6,448. So if DI had not supported, what could have happened?
Definitely, today? That's what I'm saying. If you see, 2008 and previous crashes in Nifty, DIs and this mutual fund money has been doing really well. So, I'll quote Rohit Srivastava. He had, in one of his videos that I had seen, he mentioned that, India is heading where US was 10 years ago in terms of, investor psyche, and in terms of rates, and in terms of inflation. So we are exactly heading what US was 10 years ago. Equity penetration is very low in India, but I see it improving. Initially, people used to panic and sell off as soon as, we will see, 5% on the index you'll not see every day. These are the events which you'll see in years. It doesn't happen every other day. Yes, you will see when this volatility increases 5%. In March, we had a 10% correction in the index. So you can imagine what kind of panic would have been. But Indian retail investor, the money coming in through equities, and that shift only happens when your fixed income returns start diminishing. Initially, in initial years, I remember when I was pretty small. FD returns used to be 11%, 12%. Who would go to equity for a 15%, reasonable return in equity if my FD is giving 11% or 12%? So obviously, it didn't make sense to risk your money in a equity market if your fixed income was, giving that high a coupon rate. But now your fixed income has been diminishing. FD, net of taxes, FD returns is almost as low as 3.5% or 4%. So it will barely beat inflation in the times to come, especially if we are looking at, commodity-driven inflation. So equity is the only way where most of the people, the young generation and the, new wave investors would have to go. And that is what is keeping the Indian markets afloat, even in, FIIs have been selling ruthlessly for last 11, 12 months. So DIs have done an exceedingly good job, and thanks to DI money is what, it's retail money only coming through mutual funds, or maybe people who are buying directly or through mutual funds. So Indian retail is definitely changing. Panic, obviously, days like today, everyone panics. Nobody is immune to it. But yes, as you rightly said, if it had not been for the ADI or Indian retail, Nifty would have easily corrected 1,000 points today. So definitely the wave is changing. The whole investment scenario is changing in our country.
Yeah, sir. Also, is there any way that we can find through technical analysis that what the big players are doing? Like in the stocks, it's easy to find an accumulation zone or a distribution zone, but how do we do that on a broader indices chart?
See, for broader indices, you can only make out from the RSI. That is what I have seen. Many times you'll see the RSI continues to fall, but the price continues to go up. That happened in Nifty, but it may take time. If you see, this is for people who understand charts. If you see Nifty's weekly chart, the RSI continued, peaked out in 2018 and continued to make lower lows, higher lows, and higher, lower highs for almost till 2020 beginning. But Nifty continued to be choppy, but continued to go up. So there was a marked, difference between the price, which was making higher highs and higher lows, and RSI, which was making lower highs and lower lows. So, but Nifty was, very much afloat. Though it was choppy, it was dipping and then going higher. It was very choppy for almost 2 years. Didn't make so much gains, but it continued to move higher. RSI continued to move lower. And 2018 is when the broader market had peaked out. So if you recall, all your mid cap, small cap started correcting from February of 2018. But Nifty continued to rise till February 2020 when we eventually saw the crash. So RSI will give you an idea as to where, the distribution is happening or whether an index is being managed or not. So that is where, you'll be able to get, but the only problem is, you'll not see it on smaller time frames. You will see it on weekly or monthly time frame charts. Especially weekly charts can take a lot of time to show divergence. I'll give you another example. Dollar index, almost for 2 years, it was showing divergence on the weekly chart. Dollar index continued to go up, but the RSI continued to move, making lower highs and lower lows. It took 2 years for the dollar index to tumble from 103 to 89, but eventually it did. But now the problem is, what should I do in those 2 years? Sit outside or continue to invest in wait? So, I keep telling weekly charts, if there is a divergence, it can take a lot of time to resolve. So do not sit outside. Yes, keep a close eye when the divergence starts building, but do not, sit outside waiting for the divergence to get resolved and then, prices to tumble, because it can take months or even up to years for the price to actually resolve what the divergence has been showing. Now, this I'm talking about the weekly and monthly chart. For daily charts, if you see a divergence on the index, it will correct in next few weeks itself, or maybe next few days. But and if you were finding divergence on much smaller time frame, let's say if you are finding on an hourly chart or a 120-minute chart, it might resolve in the next couple of days. So smaller the time frame for finding a divergence, it will resolve that quickly. But as you go higher into the weekly charts or monthly charts and find a divergence, it can take a lot of time to resolve itself. So indexes do show such divergences. Nifty had a classic case of divergence on weekly, but unfortunately or fortunately, it took 2 years to resolve itself. Same for the dollar index. It showed divergence on weekly charts, but eventually it took 2 years to resolve. So it can take time. It can test your patience. If that's why I keep saying, if you find divergences on bigger time frame charts, do not sit out, because you would have time to still play in the market.
So, sir, we say everything is cyclical, and specifically if for the beginners or who don't have much experience in the market, so how you suggest they should go about reading cyclicals, or what data points they should consider before starting to look out for cyclicals?
Okay. So when we talk about cyclicals, the first thing that comes to mind is commodities. So your metal, hard metals, your hard commodities and soft commodities. So in hard commodities, you have your industrial metals, your copper, zinc, aluminium, steel, and and your precious metals, which is your gold, silver. In soft commodities, you get all your agriculture produce. So soybean, sugar, coffee, tea, coke, every, corn, whatever are the tradable soft agriculture produce that gets traded. Now, cyclically, these you cannot just invest and, forget them for years. because all these commodities that I'm talking about have a lifespan, in terms of prices going higher and then drifting back lower. Now this is all linked to your dollar. Dollar, if starts strengthening, your commodities will start weakening, because holding a commodity in all these commodities are traded in terms of US dollars. So if your US dollar strengthens, it becomes expensive to hold that commodity, and eventually the price of the commodity starts going down. Now, dollar follows. I mean, some of you, if you have seen my video, I have a session on the dollar index cycle. So the dollar follows a bull cycle and a bear cycle. So if you see last 2-3 cycles, it follows a 9-year up cycle and a 7-year bear cycle or a down cycle. The last up cycle ended in 2017. Now, the biggest confusion in the analyst community is a top in 2017 was around 103 something, and 2020 dollar index almost made a double top, but slightly lower than the top that it made in 2017. So if we count that bear cycle from 2017, we have a dollar bear cycle going right up to 2024. The last dollar bear cycle was in 2001 to 2008, when we had the commodity, bull cycle and the emerging markets going higher. So if you recall, in Nifty did extremely well. All your metal stocks, sale was at 1 or 2 rupees, went all the way till by in a 60x or a 70x. Vedanta went for a 500x. So there were many metal stocks and agriculture stocks. All of them went into multiple, multi-X's at that time. Now that time, obviously, inflation used to be higher, so your stock price multiples would definitely be higher. Now inflation is not that high. We were above 10 during those times, but we are at much lower inflation levels. So obviously, you'll not get the same multiples in this commodity cycle. But looking at the trend of 9 years uptick, 7 years downtick, then the next 9 year was 2001 to 2008. 8 is where the commodities bull peaked and equity bull peaked in emerging market. From after that, in 2017, the dollar DXY again has peaked, and then we have slowly been going down. So that is how your cyclical. You have to look at the dollar, what the dollar is doing. If dollar strengthens, obviously your cyclicals will start getting weaker. If your dollar starts a bear cycle, obviously you will see a commodity or a cyclical cycle starting. So last 2008 we got the commodity peak, and now again we have started. Though ideally it should have started from 2017, but if you see many of the stocks like all these rains and graphites and HEGs and all the commodity plays stocks had actually started running from 2017 itself. So they had a sharp correction after that, but they haven't touched the same lows that we did before they started rallying. So they made a higher low and they have started moving up again. So we have to see whether this cycle we have to consider from 2017 for the next 7 years, or we consider the topic to 2020 and then go all the way till 2027. So we'll have to see how the price behaves. For now, base case, I am considering that 2024 the dollar index might bottom out, and that might also signal the peak of this particular cycle of commodity before a meaningful correction happens. So we'll have to wait and see. But 2024, another 3 years easy, we have the commodity cycle or the cyclicals into play.
Okay. And sir, one more question. So they should start learning technicals. I mean, those who have experience, they know, but for the beginners, what would you suggest?
So see, there is a lot of free content available on Google. I would not say that you buy my videos or don't go for other analysts. You choose whatever suits you or whoever style suits you in learning. A lot of free content. Investopedia.com is a very good website if you want to learn basics about what charts are, how to start reading charts. So, and that is what even I did. Investopedia.com. There is entire chapter by chapter description of what parameters to track, what are indicators, what are patterns, how a candle is to be read, how a trend line is drawn. So you'll find everything. So on weekends or whenever you get time, if you can find time, do spend some time on that website. It's a very good website to start learning basics. But yes, it's always good to know how the price works, so that eventually, prior to me getting into TA, even I used to, panic whenever the market stopped or, the book losses and exit. But now, it makes much more sense to understand why the price is following and where it can bottom out, whether I should hold or exit. So it will give you, more peaceful sleep rather than worried about that, today index crashed 5%, I should exit equities completely and go to FD and all. You might miss the next rally. So it's always important that if you can have some basics of technical analysis, again, I reiterate, technical analysis is not a holy grail that, it's a line in the stone that, this will be whatever you are saying will happen. No, it's a game of probabilities and possibilities. They can, play according to your analysis, or they may not play according to your analysis. So most of the time, I face that people, ask me that, this is what you had said. You have to understand, it's a probabilistic, study. You are only playing with probabilities. You definitely don't have 100% probability to play with. You will have a probability, you will have a support level to play with. Yes, if the market breaks it, you have to find the next support. That's all you can do. If you do not, want to find the next support, obviously, you will trigger your stop loss and exit that trade. So it's a probability-based study. It's good if people follow that, at least the basics. I'm not saying that everyone should become a master, and if you master it, nothing like that. But it's always good to know some bit of technical as to why is price behaving the way it is behaving. So Investopedia.com, there are books on Elliott waves. Elliott waves, I do not, prescribe to beginners because it's a bit of a complex subject. Once you get hang of what are the supports, what are the resistances, how the price moves, how the Dow theory works, higher high, lower low, higher lows, if the stock is making or index making higher lows, it's in an uptrend. And when it starts making lower highs and lower lows, it's in a downtrend. So once you get the hang of the Dow theory and how to identify a support, how to identify a resistance, how to identify a trend, then you can shift to Elliott wave. So, though Elliott wave, is a bit a complex subject, but if you understand Dow theory well, it makes life much easier. It's nothing but your Dow theory plus your Fibonacci plus your, RSI. Because wave, it's the same thing. Elliott wave is nothing but you have 1, 2, 3, 4, 5 followed by an ABC. So your 1, 2, 3, 4, 5 is nothing but your Dow theory, which is your, higher high and higher lows. And then ABC is, making a short-term trend. RSI, you use to identify where my wave is going to end. Because otherwise, you never know where my wave will end. So RSI helps you identifying where my particular wave will end. And similarly, Fibonacci is normally, when you are going through higher swing highs and swing lows, we do not know when a swing low is coming, how deep my low can go. So Elliott wave will help you in identifying the support. So you have Fibonacci ratios 23.6, 38, 50, 61.8, which will help you identify in which wave you are you are in, and what could be the swing low levels for that particular wave. So it's just a combination of your Dow theory, your Fibonacci, and your RSI, which makes Elliott wave, nothing else. So if you can master your Dow theory, support, resistances, and top it with RSI and SIP. That gives you your elite wave. That's it. So a lot of free content on the internet. There are books that you can get. So I have shared a book from Robert Prechter and Frost for this elite wave principle. But I would suggest for beginners, go through simple basics of price action and then go into more complex subjects like elite wave and all.
Yeah, thank you, sir.
Sir, also all of us, we say that, Bhav Bhagwan che, and, human are the driving force behind driving all the price movements in the stock markets. So do you think this technical analysis also somewhere stems into behavioral finance?
Yes, I mean, see, human behavior doesn't change over decades or centuries or even, millennia. So you'll see humans behaving the same way. In terms, whenever there's panic, we will all panic together. Whenever there is euphoria, we'll all tend to get into a euphoria. These patterns and these supports are nothing but how the humans behave in a particular situation. So now if you see there are pennants and falling wedges and rising waves, flagpole and what, they are proven patterns that form based on the human emotions, how humans react in a particular situation. So let's say I'll give an example of a typical flagpole. Now, if you have had a sharp rally which has formed the pole of the flag, and then obviously there'll be a certain set of people who would want to exit and book those profits. But the underlying momentum of the stock is so strong that you will not get a dip. You will end up getting a sideways movement where a particular set of people will exit and a new set of people will onboard into that stock. So that handshake will basically form your sideways movement. Now, the dip only comes when everyone is convinced that no, boss, this stock is worthless, let's dump it. Sideways movement mostly happens when there is a handshake between a bull and a bear, or two traders who are basically the first one is getting off the train and the second one is getting on the train. So that handshake leads to a sideways movement which ends up forming the flag of this whole flagpole pattern. And once that handshake is complete, there is no further supply from the previous holder. Obviously, your next set of rally starts. So it's all about human emotions. These patterns keep repeating because human emotions keep repeating. So that's why if you are able to know what the pattern is forming, you will know that humans are going to carry out or behave the same way as they have done all these years. So eventually, my price will either go up or go down. So all these patterns, your supports and resistances are all based on your human emotions that get repeated over time.
Okay, sir. So, sir, we have some questions from the audiences. So, if you allow, we can put
Yeah,
those
sure.
questions.
Please go ahead.
So, there is one question, sir. How to exit these stocks where fundamentals are good but price is breaking the support?
So again, if the fundamentals are good, look at the higher time frame. If you are seeing a choppy price on the lower time frame, I'll give you an example. Sale is going down. It might be a short to medium term move, but in the long term chart, let's say a monthly chart, is the price breaking those supports? If not, definitely, I mean, if the fundamentals are good and improving, your higher time frame charts will not break down. So if you are looking at charts breaking supports, even if fundamentals are good, either you have to understand whether you were trading. If you were trading, you have had to keep a stop loss and you should exit that trade. But if you are an investor, look at the higher time frame and see if the charts are still okay, then you just need to sit out or maybe use that dip to add your position.
Fine. Sir, we have another question. They're asking for your view on natural gas, and they have specifically asked about one stock, so that we won't be taking. So, your views on natural gas, sir?
See, natural gas has been going pretty, high, and Europe especially has seen, energy crisis, not just the natural gas, even electricity. So I haven't checked the natural gas chart of late, but I'll share it on Twitter for whoever asked that question. But yes, natural gas has been doing very well. The prices have gone up pretty sharply. So I'll have to check the chart and I'll share it. But for now, natural gas looks definitely bullish.
So Mishika, you have any question from the audience?
Yes, sir. So there was this question that, when you often talk about RSI divergence, so when does one take an entry or an exit based on a long short RSI divergence?
Yeah, so like I mentioned, if you are looking at, let's say, a very short-term chart, let's say a 15-minute chart, and if you are trading for the, let's say for next 2-3 days, pick up a shorter time frame chart, 5 or 15 minutes, 15 minutes, or if you're trading for 2-3 days, you can even pick a 30-minute chart. And if you find divergence there, let's say if you are, divergence is forming on the lower side, it's a positive divergence, that will get resolved pretty quickly. So I understand most of the people want to trade, in and out pretty quickly. So do follow, shorter time frame chart. A 15-minute or a 5-minute divergence will resolve in the same day, provided the divergence formed earlier in the day. But if the divergence formed, a bit later in the day, obviously it will be resolved the next day. 30 minutes on an hourly chart, the divergence might take 2 to 3 days to play itself out. So if you have the time frame of next 2-3 days, look for a 30-minute on an hourly chart. Anything which goes higher will take more time to resolve. So if you are in for a quick trade, go for shorter time frame chart. If you have a positional view, let's say you are okay to wait for a week or two, or maybe slightly longer, you can go for a daily chart to play out your divergence. So and position the time frame accordingly. So first you have to know what is the time frame that you're looking at to play with. If you want to play intraday, don't go above 15 minutes. 5 max 15 minutes, because if you shift to a 30-minute chart to play intraday, it might take longer than that. 5-15 minutes should be good enough. And yes, like I said, if these divergences form later in the day, obviously they'll get resolved on the next day. So play accordingly, and the divergences. And please, don't play 50 weekly divergence on weekly chart, because they can literally kill you with all this waiting time. So max stick to a daily play the divergence on the daily chart, and or lower time frame based on how quickly you want it to play.
So I also had one more question. So how do you manage risk, and how much cash do you keep for uncertain times?
See, again, like I covered a while ago, 6 months, if all the funds that you might need in the next 6 months should be your emergency fund. Do not put it in the markets or trade with it. Always have an emergency fund that can take 6 months, or rather, 6 to 12 months of your expenses. That includes, your general day-to-day expenses and your medical expenses as well. So never. That's why I think I get a lot of tweets where people say that I'm waiting for the salary credit, then I will buy this stock. Very incorrect. You are yes, I understand if you are young, you are dependent on your parents, there is a backup, understood. But if you do not have a financial backing, you have a family to run, or you are independent, do not invest money that you are going to get in that immediate salary. For that matter, 6 months is the bare minimum that you should be keeping aside. How lucrative the market might look, do not touch that money, because markets can remain uncertain. They can remain low for weeks and months together, and your money might get stuck. So never land up in a situation where you have to go for a loan from a friend or a relative just because your money got stuck in the market. So always keep an emergency fund, minimum of 6 months to 12 months of your expenses, which you just keep it aside, maybe in an FD or wherever you want to, but not in the market. So please, keep that in mind. It's the safest thing to do. Do not take risk with the money that you might need in the immediate future.
Very true, sir. So, sir, we have another question. How to find reversal in any chart when we have seen a head and shoulder breakdown on charts?
So yeah, so when you have a head and shoulder breakdown, your first target would be your one of the shoulder heights. Once that is done, your final target would be height of the head. Once that is achieved, you will have to then wait for a divergence in the RSI. It's not that once the target, the head height is complete in terms of the correction amount, your stock will start turning up. No, you can still go deeper. So at that time, you will have to look for a divergent RSI. Let's say if a breakdown was on a daily chart, shift to a lower time frame and look for a divergence in RSI. It might be on a 120-minute chart or a 240-minute chart, or maybe for that on a 60-minute or hourly chart. So look for the divergence to form before you get a reversal. Now, if that is what I posted a while back. Dow Jones has become oversold on daily chart, but there is no divergence yet. So it may so happen that it can continue to correct for some more, then maybe go for a uptick and then down again at the same low or slightly lower low, but you will get a divergence there. So once a divergence is formed, you can easily be sure of that a reversal might be. If not a reversal, at least you are ready for a good bounce from those levels. So always wait for a divergence to form on the chart before you actually call it a proper reversal.
Thank you. I hope that answered the question whoever asked. So another interesting question, sir, like he has mentioned that in war-like situation, the commodities ought to do well. But in current scenario, the good, decent commodity companies are nosediving. So what could be the possible reason?
So see, commodity companies are nosediving because of the extreme emotions, because everyone is dumping whatever they hold. But if you would have seen, all the commodities have spiked up today. Aluminium 5%, copper, okay, not doing that much, but natural gas, everything has spiked up today. Now that said, like I mentioned, your companies are not going to turn around overnight. If a war happens tomorrow, in copper will not get rid of its debt tomorrow morning, or sale will not become debt free next week. Obviously, they'll have to accumulate cash gradually and then start turning around. So, but initially for immediate future or in the present term, everyone will panic. So even if I'm holding an excellent company like say a Hindalco or a Tata Steel, my first reaction would be dump it. A war has started. Let me get out of equities and move to the safety of cash. That is your first human reaction. How Tata Steel is going to benefit because of that in gradual time, nobody would look at that. It's immediate, human reaction. It's a fight or flight. So we can't fight because we can't control the market. Your first reaction is flight. So you dump and exit. That is why I've been tweeting since morning. If we are holding commodity stocks, do not take hasty decisions and book losses. You are eventually turning up in a commodity cycle. Yes, there is short-term pain. The markets are bleeding. Your stocks have tumbled 20, 25% or 30% also in some cases. But eventually, with time, all these companies are going to show much better balance sheets, and they will have their stocks getting re-rated. But that is a gradual process. But as I said, human reaction is fight or flight. We can't fight, so we fly away.
Okay, sir. And one more question is on reversal of mid caps. So, what's your view on that, sir? And I would like to ask you about how we are on time, because it's already an hour.
Do we have a lot of questions left? Maybe you can take up another couple of questions. So
Yeah, sure. And
Yeah,
if you allow, we can take few questions from the audiences as well. I mean,
sure,
live
sure.
questions if you
So
allow.
mid caps index like last checked, we are almost touching the highs of 2018. So that will be a good support. We should have some bounce coming from these levels. Again, mid caps, I didn't check the chart of the short term, but long term, we have almost close to the 2018 top. So we're looking at strong support there. Not in Nifty as such. Nifty is much higher than what it made of that 12,430. But mid cap, small caps are looking at indexes close. I'll post a chart tomorrow morning for reference. But yes, I'm again waiting for the divergence to form, because mid caps, as I see, have maybe if you can give me time, I'll quickly check the Nifty mid cap chart. How much? Yeah, so mid cap again is oversold on daily chart, but no divergence yet. So I am anticipating a small bounce and then another move toward the lows, or maybe slightly lower low to end find a sustainable bottom. But right now, yes, we are definitely oversold on the daily chart, so we may get a small bounce, but I'm anticipating that it will be sold into, and we'll make another attempt at reaching the lows or maybe even breaking the lows. So I'll post the chart, a long-term chart of mid cap, to see how where the strong support is. But yes, as of today, mid caps are oversold on daily chart.
Cool, sir. So, Mishika, any questions from your side?
Sir, I wanted to know that whenever we talk about technical analysis, we also think that what about the open interest data? Like many a times we see a breakout in the chart, but then when we go and check the OI data, there is option selling in the next strike price itself. So how do we deal with false breakouts?
So, Michika, I won't be able to talk in terms of futures and options because I don't have much knowledge there. But breakout, how to trade a breakout. So, never run to buy a breakout stock. Because most often than not, if a breakout happens with low volumes, it mostly will fail, because normally breakouts happen when there is interest from the institutional investors like FIs or maybe HNIs, DIs, because the fundamentals of that particular company are changing. So they start lapping up the shares of that particular company, and you will get a breakout with huge volumes. So that is the biggest criteria. If the breakout is not with huge volume, it could be because of retail euphoria, and it's most liable to fail. So always check the volumes when you are chasing a breakout. And then we have a strategy called as breakout retest. Whenever there is a breakout, I will not say 100%, but more often than not, the price will come back to retest the breakout levels. So that is the time you have to keep ready and watch if the breakout sustains. Because many a times what happens, people tend to chase a breakout and eventually get trapped at higher prices. And if the breakout fails, you are trapped at the top of the price, or maybe the high prices itself. So it's a very safe strategy to assume when you have a breakout, let the price go up, like we had in the case of methanol oil. We went to a 1230, 1240 odd, and then the price came back to retest the breakout around 1060. I didn't see what the price today is, but it did come back to retest the breakout. And if the retest is successful, if it sustains, that is where you can catch that stock. So that's a safe strategy to adopt rather than chasing a breakout, because if it fails, then you're stuck at the top. And volumes are very important indicators to keep track of when you are trading a breakout.
Sir, also I had one more question. How do you place your stop loss while trading?
So that would depend on, see, many people keep a 2% stop loss, below their buying price. If you are in profits, for let's say if it's a positional trade, you can keep a stop loss based on your risk appetite. Many people even keep 5% below their buying price. So that varies from person to person. It's completely based on your risk appetite. But 2%, is a good stop loss to, save your capital, because 5% can erode your capital if you continue to hit too many stop losses. So 2% is a safe stop loss, or you can, if you do not want to go in percentage terms, you are buying just, above a strong support, keep that support, as a stop loss, maybe in terms of if you are, doing intraday, then keep the, 15 or 30-minute candle close below that support zone as a stop loss. Or if you are doing a positional trade, maybe any day the price closes below that support, that can be your stop loss. So if you are trading just above a support zone, keep that as a stop loss. Otherwise, if there is no support nearby, you can keep 2% or 3% or up to even 5% as a stop loss for your trade.
So, sir, we have one or two more questions. Like, one person is asking, he is heavily invested in commodities and he invested near the market high when market was at top, and now he is not left with any cash to average, or he didn't sell those commodities because the market has corrected. So what would you suggest for him? And also he has asked for Ukraine's impact on US market.
So, Ukraine's impact on US market, I'll take the second question first. Ukraine impact on US market, it's a world event, so all the markets are getting impacted, so not just be the US market. Yes, if you are invested in US markets, obviously you will be feeling the heat. But, but this is a world event. At the end of the day, this entire world is one market. Yes, we have different indexes and different charts. So if, when such an event happens, somebody will correct more, somebody will correct less. Russian index corrected 50% today. So you can imagine if Nifty would have hit, 8,000 today, what would have happened in our country? So every index will behave a bit differently because every country is in a different economic cycle at a given point in time. So, US may react a bit differently, may not see the, immediate pain, because the US, I believe, is not a very high, importer of, gas or crude from Russia. Europe definitely will feel the heat because everything has spiked up in terms of crude and especially natural gas. So European markets might, if you see Europe has corrected a bit, almost 3.5 to 4% as compared to US, which was, less than what, Europe or for that matter, our markets correct. So every index will behave differently. To answer your second question, first question, commodities, if you are fully invested and you are invested at the top, just enjoy your beer or tea, coffee, whatever you want to do, sit on the sidelines, let this event move out, and keep an eye on the dollar, because if the dollar continues its downtrend over the next few weeks and months, you will be able to recover, your prices or even, generate profit. So commodities, the setup looks interesting. I would not say that everything is in stone, but the setup, medium to long term setup definitely looks interesting. Dollar has already broken down of a head and shoulder pattern on the weekly, from the weekly charts. So dollar looks very much bearish. Yes, you are having short term spikes like we have had one today. But on a longer time frame, dollar definitely looks, for a down drift in the future. So that will definitely aid, commodity upcycle. And like I explained, once the books, these commodity companies start looking better, you'll see your stock price, looking much better, and you'll be able to recover your prices and even make profits. But yes, you'll have to sit out and wait for this cycle to play out.
So there is a question from the audience that one of them are very heavily invested in mid-cap IT companies, and it's a leveraged portfolio, and they are down by 35% now, and there is no bandwidth left for averaging presently, at least for a month. So what do they do?
See, again, you have to, like I mentioned, you have to look at, higher time frame charts. If you see a breakdown, 35% is indeed a big dent on a portfolio. I normally prefer, max 30% of a drawdown on my portfolio. I'm just around 15, 16 at the moment. 30% is what I'm comfortable with. In worst case, 35 is definitely a big dent. Just assess your portfolio and see the stocks that you're holding, whether they have, broken down on higher time frames or not. So if a weekly chart looks bad, then, it would be good to book out, if you're in profits, then it will be reduced profits. If you are looking at losses, you might need to look and, book out your losses and save the rest of the capital. But I believe, let this event get out of the picture. We should do that pretty, quickly, because, it's at the end of the day, it's still not a full-fledged war that, media is portraying it to be. It's more of a separatist movement that Russia is supporting, and they haven't gone for a full-blown war, and no country can afford a full-blown war at the moment, especially after what COVID has done in the last 2 years. So it might be a small-scale event, but yes, we'll have to wait and see. If it gets complex, if too many countries get involved, then this might become a bit messy. But at the moment, it doesn't look like what maybe a Gulf War was, or a bigger wars that we have seen. So we'll have to wait and see. But yes, technicals are suggesting that the dollar may find resistance pretty soon. Around 97.75 is where I see that the DXY should see a lot of supply. So that would help emerging markets start performing better again. So that is where then you can assess whether your mid-cap IT is an underperformer or is doing as good as the index is doing. But if it continues to underperform, that then you might want to look at your portfolio and do a bit of reshuffling.
So, sir, we saw, as you were discussing about euphoric times, basically the valuations for mid cap ITs was sky high near the top. So, how you see them going forward? I mean, they will be into time consolidation, or?
So, see, to be honest, I'll have to check the chart of mid cap IT companies, how they've been, how they look on the chart, because I've not been keeping a close. Honestly, I've been, totally focused on commodity play, because that is where I see, the max amount of interest that would get generated. Maybe, not in the immediate future, but eventually it will get generated. So I'll have to check the chart of the mid-cap IT companies and see. IT, I was not too bullish. I've been sharing some of the IT charts, Infosys, Wipro. TCS looked good. So I'll have to check what happened to TCS today, because TCS looked bullish. Wipro and Infosys, I was hoping for another dip close to the last lows that they made around December. So I'll have to. But these are large cap IT, mid cap ITs. I'll have to look at and see how the charts are looking, and whether it will be time to exit these companies, or it's just a momentary downtick, and they might follow another upcycle after this. So I'll check in and I'll share it on Twitter.
Yeah, sure. Thanks, sir. And sir, I was discussing about cyclicals. So what all cycles one need to, focus if they are into long-term investing? I mean, there are various cycles, right?
Right.
So what?
So basically, you have to, like I mentioned, you just have to keep an eye on the dollar, and your these businesses will start peaking out a bit before the dollar peaks out, or rather the dollar bottoms out. It's a reverse thing. They're inversely correlated. So when the dollar actually bottoms out, these businesses will start peaking out much before. So you will see all these companies posting excellent results, massive PATs and all these kinds of stuff. So that will happen a wee bit before the dollar bottoms out. It will not be a day-to-day correlation that dollar bottoms out on 1st of April and that is where my cycle ends. No, your cycle might peak out slightly before the dollar bottoms out or maybe slightly after. So keep an eye on the long-term charts of the dollar index and the long-term charts of the stocks, of the commodity stocks that you are holding. So there'll be long-term resistances, long-term trend lines that these might be hitting in the next few years, and keep a close eye on the USD. As soon as the dollar starts looking, it's tending towards the bottom, or towards the bottom of the channel, and you can maybe start exiting your investments and not wait till the last day or the last month. For that matter, if it's you start exiting 6 months to a year before that, even that would be good. So do not wait till the last that I'll be able to catch the exact top. You can only get lucky if you do that, but you won't be able to time it, believe me. So you'll have to either start exiting. That might mean that you let go of a few few percentage point profits, but that's okay, because when the downtrend starts in commodities, the downtrend is pretty sharp. So price corrections are usually very sharp, and then they will cut your profits pretty quickly. So it's better to stay contented with lesser profits rather than watch them seeing deeper cuts at a later point in time.
Thank you, sir, for sharing your insights. I think we are also hitting our final target on time for today. So thank you, sir, for being very generous with your time. And it was truly awesome from learning from a pro trader like you. You shared a lot of your experience and wisdom in this space, and it was great learning for all of us. We hope to have a part 2 of this conversation really soon, and really appreciate your time on behalf of all of us. Thanks for catching us live on Twitter Spaces, and have a great weekend.
Yeah, thanks guys for hosting me, and thank you all for giving your time listening to me. I hope it was helpful, and I again reiterate, do not panic, and if you are a long-term investor, just sit out of this, watch how the events unfold, and do not take wrong decisions in this panic. Just sit out, look at the market from the outside and see how things unfold. Thank you all for your time, and good night to all of you.
Nishant bhai.
Yeah.
Nishant bhai, Nirav here.
Yeah, Nirav.
Sorry, if you can just permit me, first of all, really thank you for hosting this and getting Nishant bhai also on the deck. So Nishant bhai, actually एक point था कि see, as you explained correctly regarding the commodity cycle. So what is your view on the ethanol story, ethanol sector?
Yeah.
War-like situation, definitely it will not happen anything like that. Maybe it is a pain of around 2, 3 or 1 or 2 days. Maybe from next week we may see good bounce. But what is your view on the ethanol stocks or ethanol sector, or how it will impact our ethanol industry, because it is totally Indian manufacturing basis only, correct? So
correct, yes.
Everything is being grown in India. I am only focusing not on the ethanol made from the sugar, but ethanol made from the grain-based stocks. So grain-based sector. So on this sector, what is your view? So sorry, in case if you have 5 minutes, please.
Yeah, sure. See, if I go by the data Praj did exceedingly well in the last commodity bull run. It was a multi bagger. Having said that, ethanol story will catch even more attention if crude continues to stay high, because we all know Indian government is focusing on increasing the ethanol mix in the retail fuel. So as if this whole crude market continues to stay elevated, blending with more and more ethanol will make a stronger case, because at the end of the day we can't have very high fuel prices because India is a net importer. So ethanol blending will catch a lot of attention. At the same time, when there is your consumption going up, economy looking up, obviously your demand for fuel and for demand for other soft commodities, what I've been talking about, will always catch attention. So net, your soft commodities will be doing well, and since your fuel prices will have to be controlled somehow, ethanol blending, I'm not sure what's the status in other countries, but India is definitely looking at increased level of ethanol blending. And as the economy picks up, obviously your fuel consumption will go up, and that would mean your ethanol consumption will go up. So definitely this space looks exciting. So it's not about your just fuel prices going up. Obviously, as the demand goes up, consumption goes up, you would have more cars on the road. Yes, electric is coming as a big competition, but that's not happening in a year or two. It will take time. Fossil fuels will continue to be a major part of the economy in the foreseeable future. So as the economy turns, you will have more cars on the road, you will have more demand for fuel, and that will obviously help ethanol companies to do better. Mirav, I hope that answered the question.
Yeah, definitely. Thank you, Nishant. Thank you very much.
Sure, you're welcome.
Thank you.
So guys, we also have Nirav sir here. So Nirav sir, what's your take on the current market scenario, and how do you deal with it, with the drawdown and with the fall in the portfolio? Like, do you just prepare your watch list, or you even take some stop losses at current scenario?
No, the thing is that Mishika, see, it's like जो सुनामी आ रही है वो तो सबको डूबेगी लेके, करेक्ट. तो ऐसा नहीं है कि माय पोर्टफोलियो और माय स्टॉक्स और लाइक दैट के they were very strong enough. ऐसा नहीं है. I think if, say for example, if I'm having TCS, so even TCS was also down 3-4%. Infosys was also down. So like that, what we have to see, in case if you see for a long-term investment, there are, as Nishant bhai correctly explained, if you are an intraday trader, positional trader, swing trader, or a long-term investor, then this kind of opportunity, basically this kind of thing is an opportunity for you. And definitely, yeah, everyone cannot have a point to buy it every time. Even today, I also don't have a cash to buy, even in this dips also. And obviously, I have to churn some, I have to sell some and then buy. If I like TCS, then I will buy TCS. If I like Infosys, then I will buy Infosys or Asian Paint, whatever, or Gulshan, whatever. So the thing is that basically what you have to see, that if you are a long-term trader, then definitely this is an opportunity for you. Like in 2020 also, when the COVID crash came, no one was like thinking that yes, today we will be seeing even 18,000 also. And everyone was thinking कि यार tomorrow everything will get collapse, and मतलब यहाँ पे हमें कुछ मिलेगा ही नहीं. बजाज फाइनेंस 1500-1800 रुपए का भाव आ गया था, and today Bajaj Finance was touching 8,000, and today no doubt it is 6,500 whatever. So thing is that yes, if you are having a conviction on your stock, on a fundamentally good stock, then definitely you need to keep some buffers amount also in this type of situations when it comes, so that when this type of situation come, you can buy at least some amount. Say कुछ भी buy कर सकते हो, and therefore I think it's a good opportunity. Even like tomorrow also, no doubt, I think some bounce back maybe there tomorrow, like the Dow is also performing today. So maybe some bounce back रहेगा. And next week I also think that amicably everything gets settled. So it is a good scenario that whatever the quality stocks which you are thinking, you should buy at a very in the dips. ये मेरा मतलब बेसिकली एक अप्रोच होगा.
Okay, so thanks for sharing your view. And it was a great session today, Nishant sir, learning from you and Neerav sir, even your insights, like it was cherry on the cake. Thank you guys for attending today's spaces, and we really had a good time.
Thank you all. Yeah, and have a good night.